Hello and good morning. My name is Jawwad Farid and I will be your host today at the Valuation in Pakistan dataset conversation. We ran this lecture a few days ago at the 9 to Disrupt conference in Karachi. There were a number of requests to see if you could share a recording, and here we are back in front of you with the deck and the numbers one more time. What's the game plan? The game plan is fairly simple. As a startup or a founder, there is one question that has been bothering you a lot over the last few months. Given everything that's happened with the exchange rate and the interest rate environment in Pakistan, what are the appropriate numbers to use for your financial models? Two big questions. One, what's the right exchange rate to use, not just now, but for the next 3 to 5 years? Two, what's the right hurdle rate or IRR to use as a discount rate in your model for discounting future cash flows? That's the first part. I'd like to call this the darker part of a conversation. Unfortunately, given everything that's happened and is likely to happen over the next few months, there's not a lot of good news on the rates front. But there is some good news, and that good news comes in the shape of a market sizing exercise. Market sizing conversations in Pakistan are often focused and centered on a slightly different question. How big is the Pakistani middle class? And how much do they spend? That's one. I think a second follow-on question is the middle class growing? And if it's growing, what's driving that growth? If you're thinking education, you've got it in one. And then we move on to the brightest part of our conversation, which is there an alternate model or way of looking at the growth question? So 5 questions: valuation, market sizing, middle class, education trends, growth, and complexity. If you're looking at a deeper dive or reading material to get a handle on the material covered today, a large part of today's lecture is based on the second edition of my book, Founder Puzzles. Alright, let's begin. So part 1, valuations. 3 questions. What's the right exchange rate outlook for your valuation model? What's the right interest rate outlook for your discount rate? And given these two, what's the right IRR and hurdle rate to use for discounting future cash flows in your financial model? To answer these 3 questions, we're going to look at 3 different types of models. The first is my favorite. Let's take a look at the exchange rate environment over the last 19 years, all the way from 2003 to 2022. Now, the rates you see here are going to be slightly different from the rates that you've seen in newspapers. And the reason for that is that I'm not looking at a day-to-day rate, but I'm looking at the average annual rate for purchases spread over the entire year. So for example, the 58 you see here for 2003 is the average annual rate for the US dollar, is the average annual rate for exchanging the US dollar into the local currency. This is the USD PKR exchange rate. Similarly, the average rate that you see here of 101 in 2014 is the average USD exchange rate for the year 2014. And the same holds true for the 200 figure for 2022. While you clearly see a trend, is there another way, is there another lens that we can use to look at the same data set? As I said, this is my favorite model. Drawing room conversations, armchair conversations, conversation with the Pakistani diaspora, all love conspiracies. 2008, 2013, 2018. What's the common theme? 3 years, 3 elections, 3 exchange rate adjustments. Is that a trend? Is that a coincidence? Or is it a conspiracy? What do you think? This, by the way, is the same dataset we saw on an earlier slide. The only thing I've added is the percentage change, the depreciation in the USD PKR exchange rate. So if you look at 2008-2009, you actually see that the adjustment didn't happen in the year of the election, in the year leading to the election, but carried on for 2 years. The same is true for 2012 and 2013. However, 2018, 19, and 20 are the years that break the trend. 15% in 18, 24% in 19, which was not an election year, it was a year after the election year, and then another 8% in 2020. So if the trend holds, you would expect the depreciation to happen in 8, in 13, and in 18. However, the 18 trend is the trend that breaks the trend. If the conspiracy model holds, you'd expect to see the same trend in the 3 years, 2008, 2013, and 2018. But the adjustment, the exchange rate adjustment in 2018 is the adjustment that breaks the trend. We actually have not 1, not 2, but 3 years of higher than expected, higher than average exchange rate depreciation. And given what we know of exchange rate adjustments, at least as far as the data is concerned, we've got a strong indicator that 2023 will be an election year. Is this true? Does this make sense? At a superficial, high level, there is something here that is worthy of future exploration. We're not sure if there's a conspiracy, but we're sure that there is something deeper at work here that we need to investigate and explore. And the answer to that question, my friends, is model number 2. Model number 2 tracks the interest rate differential between USD PKR as well as the inflation rate differential between USD PKR. For example, if interest rates in Pakistan are at 16%, and the relevant interest rate in the US is 14%, the interest rate differential between the two is 12%. If the inflation rate in Pakistan is at 28% and the inflation rate in the US is 8%, the interest rate differential between the two is 20%. Model number 2 indicates, tracks, or suggests that the expected likely future currency depreciation is going to be linked to one or two of these factors, the interest rate differential or the inflation rate differential. Do we have data to support this? Take a look. There are 3 lines here. The first line, the orange line, this line, this line, this line that you see here. This line, the first line, the orange line, represents the interest rate differential for 1-year bills and bonds. The second line, the yellow line, this line here, which starts in essentially, I think, 2010, looks at the inflation rate differential. Now, the third component, the plot in blue, tracks the year-on-year currency depreciation. And you can clearly see as the interest rate differential rise, currency depreciates. As the interest rate differential rise, currency depreciates. As the interest rate differential rise, the currency depreciates. The USD PKR exchange rate depreciates, is likely to depreciate more. Sometimes depreciation is driven by the interest rate differential, sometimes it's driven by the inflation rate differential, sometimes it's driven by both. However, if this model holds, there is a little bit of good news here, right here towards the last read of the data set. You can clearly see that both the interest rate differential and the interest rate differential are started to head south. They're turning. Question is this a permanent peak? And are we going to see lower values for these two indicators? Or is this just a temporary adjustment which is likely, may possibly bounce all the way back up again? So what's the model? The model basically says, depending on where the differentials are, you are likely to see the same trend reflected in the exchange rate depreciation side. This is not an exact model. This is not a predictive model. This is not a timing model. This is a directional model, which basically means depending on where these differentials are, there's a reasonable chance that your currency may appreciate or depreciate with respect to the US dollar. The trend is likely to hold over the long term. You can't trade, you can't predict, you can't monitor using these indicators and trends on a short term. So you can't trade today or tomorrow. You might see some adjustments and shifts. In the long run, over the long run, the trends are likely to converge in the same direction. So remember that it's a trend. Model number 2 is also closely linked to model number 3. What drives the interest rate differential? What drives the inflation differential? What drives the currency rate depreciation? And model number 3, to our mind, essentially looks at trade data. So model number 3 looks at trade, balance of payment, and current account deficit data. In this specific case, what we've done is we've done a plot. So here on this side, 5 to 6 refers to fiscal year 2005-2006, and 21-22 and 2021 refer to your CAD numbers for fiscal year 21-22 and 2021. The second thing we've done is, so we've also, the orange line, the blue line, these bars represent your CAD figures. The orange line represents your exchange rate. So for example, in 2005-2006, your CAD figure was minus 4 billion. In 7 and 8, it increased, went up to about negative 12 billion. And you can clearly see the impact of that on your exchange rate. So you went essentially from the low 60s to the high 80s. 2009-10 to 15-16, you had a relatively stable period with respect to your CAD figures. That outlook changed again in 16-17 and then in 17-18. And once again, you can clearly see that once you moved in that direction in 16-17, there was no stopping the exchange rate adjustment. The 17-18 trend continued in 18 and 19. 2021 was COVID and the impact of COVID on both oil prices and our own trade balances. But you're back with a bang in 21-22 and your currency reacts accordingly in a similar fashion. So not elections, trade cycles. 3 elections, 3 exchange rate adjustments, but not conspiracy. 3 separate trade cycles. As every other leading economist has said in recent years, we need to figure out how to learn within our limits, within our constraints and our budgets. Till we fix this, nothing's going to fix the exchange rate. It's just a harsh reality of life. Here's the same data plotted and presented slightly differently. Rather than giving you the exact exchange rate, what we've done in the yellow line is calculate and plot the estimated exchange rate depreciation. You can clearly see large deficits leads to large exchange rate adjustments. Fix the deficit, you'll fix the exchange rate adjustment. As a founder, you'd be asking yourself a very simple question. Yes, thank you very much for that lesson in macroeconomics, but what do I do with respect to the rate outlook for my valuation model? Could you please answer that question? That's the question we take next. Where are rates going? So here's a plot of the Pakistani interest rate environment from 2003 to 2022. You can clearly see here that rates sort of dipped in 2004, then rose all the way up, then stayed high all the way up till about 2012. And then if you remember that cycle of stable, low CAD, we could clearly see less pressure on the economy and on the interest rate. And then they started rising again. You guess, do you remember? Do you see the shift? They started rising again as our trade balance went out of whack. Then they came down again, but this is not because of trade. This is the COVID response. They started rising again slowly in 2021 and they've risen. Now you have 3 really important questions. Going forward from this point onwards, what is likely? Are rates going to come down? Like they've come down here, 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 and here? Are they going to stay where they are as they stayed here for a period of about 4 to 5 years? Or are they, so this is 2, so this is one path, this is path number A. Are they going to come down? Path number B, are they going to stay where they are? And then there's path number C, are they going to go higher? So if you look at historically speaking, this and this, these are the 3 peaks that we've seen in the last 20 years. And given the fact that these were peaks where the macro environment was actually not as harsh or as hard as it is now, there's a reasonable chance that we are going to cross this peak, and this is path number C. So are rates going to come down? Are they going to stay where they are? Are they likely to go up? Given everything you've seen so far, what do you think? Which one of these paths, A, B, or C, is more likely? I'm not an economist, but my vote right now would be for C. This is a very contentious vote, right? from a political point of view, from a social impact point of view, from a costing point of view, from a pricing point of view, there's going to be a lot of noise if you raise rates higher. But given the history of the Pakistani rate environment, given the history of our own trade balance, given the history and the structure of our economy, I think a bet on C, on path number 3, is possibly the most appropriate bet. Is there any supporting data that would support this assumption, that would support this direction? For that, we need to take a look at the US rates environment. So here's a plot of the US Treasury curve, and what I've done is the green line, the one that you see here, the green line represents the 1-year plot, the interest rate for the 1-year Treasury bill. The orange line represents the 5-year, and the yellow line represents the 10-year rate. Once again, if you see the US market, and if you just take the 1 year as the benchmark, your peak 1-year rate is about, say, 6.5% over the last 20 years. It's gone higher, so not 20, last 25 years. So you go from 1997 here to 2022. So in the last 25 years, the peak rate that we've seen for the 1 year is about 6% plus, and for the 5 and 10 years about, say, 7% here. Right? That's 2 peak. And we last saw these rates in 97 and 99. Then there's a second peak, and this is a peak that we saw in 6 and 7, and this peak is about 5%. So we're very close in 2022, very close to 5%. Question you have to ask yourself is, in the US market, for the US environment, where are we going? Are US rates going to stop at this 5% threshold? Or are they going to go to 6% plus? Or will they actually cross 7%? And if you look back further, so if you go back beyond 1997, if you go to the early 80s, which is about in the 50-year horizon, you've actually seen rates in excess of 13, 14, 15, and 16%. But we will not be that gloomy and that dark. We'll simply say, the range for us right now we're at about 5%, between 4 to 5%. Where are we likely to stop? At 5, at 6, at 7. Your best case is maybe a 50 basis point shift or 50 bips shift, right? Your worst case is maybe a 200 basis point shift or a 2% shift. Going back to the first question, what's likely to happen to the Pakistani rate environment if the US rate environment shifts by 50 to 150 or 200 basis points? Pakistani rates will have to respond accordingly. There are only 2 possibilities of adjustments. Either you adjust your exchange rate or you adjust your interest rate. You have to give up on one of these 2 accounts. Your worst case scenario is a meltdown on both sides. Interest rates going up by 200 basis points and your currency depreciating by another 10 to 15%. Your best case scenario is rates going up by 200 basis points in the short term, so that you can take that short-term payment, not take the currency exchange rate hit. But if your trade balance doesn't improve, your interest rate environment doesn't improve, the US market moves in the direction it's moving, there's a reasonable chance that you're going to see higher rates. As I said right at the start, I'm afraid there is not a lot of good news on the rate side. What does this mean for your valuation model? What are the benchmark yields? So US yields right now for 1 year and 5 year are between 4.6 to 4.5%. PKR yields, rupee yields on on treasury bills and bonds issued by the Pakistani government in the local currency, in PKR currency, are about 15.6 to 13.83%. We also have dollar-denominated bonds, and depending on which benchmark you use, which rate environment you use, which rate reference you use, whether you're looking at June, July, August, September, October, right now, November or December, you are likely to see yields on the Pakistani Eurobond between 26 to 35%. Now remember, what does the Eurobond yield represent? The Eurobond yield represents the interest rate government of Pakistan would need to pay if they went out in the international market to borrow money. It's not just us. Yes, we are having a bad day. Yes, there is a lot of bad news on a lot of fronts. Yes, we sort of had a crisis of trust, confidence, and faith in financial markets from the other side, from the investor side. All of these factors aside, if the government of Pakistan went today to go out and borrow money in dollar-denominated terms, the average yield markets anticipate the the state to pay for borrowing in USD ranges between 26 to 35%. That's government of Pakistan of the full faith and credit and the force of the Pakistani economy behind it. If that's the rate that the state is paying, what rate would a itsy bitsy teeny weeny startup pay? It'll be a much higher rate. So if the reference rate for the state, for the Pakistani government, Pakistani economy is 35%, the hurdle rate, the IRR, the reference rate for the startup ecosystem is going to be substantially significantly higher. And that substantial significant higher difference and shift and change is represented by spreads. If these are benchmark yields, what does this actually mean for founders and startups when it comes to sitting down with investors and negotiating on what the right reference rate, the right discount rate should be for discounting future cash flows? The answer, my friend, is not pretty. So this is a slide you were all waiting for. FX short-term depreciation, about 5 to 8% per year. If you take the average of the last 19 to 20 years, I think it's about between 6 to 7%. If you ignore the last 2 years, 3 years, it'll be about 5%. If you add the last 2 or 3 years, if you don't discount them as outlier, I think the average depreciation, currency depreciation in the Pakistani exchange rate with respect to USD, in the USD PKR rate, is about 7% year on year. So that's one. Long term, depends on your outlook. Will we fix the CAD problem? Will we fix the structural issues? Will we fix the rate environment? Maybe stability. If we don't, then it's open to question. If you want a direction or a hint, keep an eye on the interest rate differential with respect to USD PKR and the interest and the inflation rate differential also with respect to USD PKR. That'll give you a sense of which direction we're going to take in the long run. Having said that, I also want you to remember that as investors, founders are also investors. We invest in businesses with our time, sweat, blood, and tears. As investors, we're not interested in timing the market. If there's an opportunity which is time dependent, that opportunity will disappear or expire if markets move and you want to explore and exploit that opportunity. You would raise capital, you would take capital. Rates go up and down, markets go up and down, cycles go up and down, but the work never stops, the work continues. So you're not interested in timing the curve, you're interested in averaging it out over the next decade or so. So that's on the exchange rate side. Now, on the interest rate side, short-term government of Pakistan debt, PKR debt, local currency debt is about between, I think a good reference rate is between 15 to 17%, maybe 18%. But that's GOP paper issued in local currency by government of Pakistan. As a startup, I think you could easily double that. You have another reference point. That reference point is what's the cost of borrowing for large stable corporates in Pakistan. That would be about 3.5%, maybe 4% on top of the reference rate that you've seen here. If you're a really large entity, established businesses, it may be 50 to 60, 70, maybe 100 basis points on top of that. But for a mid-size business, SME, small and medium enterprise business, or a small and medium enterprise, I think the reference is going to be about 3%, 3.5%, possibly even 4% on top of that reference rate. It's also a function of the local credit environment, not just a question of the rate environment, also a function of the outlook on what's going to happen on credit defaults. I think there's another year and a half, possibly 2 years for the curve to turn and peak. So your rate environment is likely to stay in the same environment. If you expect rates to come down anytime soon, I don't think that's likely in the next 12 months. Waiting to raise capital because you think rates are going to come down, I have bad news for you, my friends. Rates are not likely to come down in the next 12 to 18 months. What's the right relevant USD IRR? I think it's 35% plus. What's the right PKR IRR? 35% plus a fairly large substantial spread. Numbers news is not good. But then you can also flip this question and ask a slightly different question. And the slightly different question is, what kind of opportunities would actually generate a 35% IRR in an economy which is not doing very well? So your idea of filter needs to be recalibrated. It's no longer enough for you to just execute, deliver, build project teams, products, concepts, and ideas that will return the average rate. You're actually looking at the cream of the cream if you want to raise money and capital. And the same thing holds true with respect to investing your own time. If you want to invest your own time, even if you're not raising capital, the relevant reference rates for you to use is 35% plus. If you can find a project at 35% IRR in the current environment, why would you want to share it with random strangers? Think about that. So what's the optimal strategy if you're a founder and startup? My guess is that I think it's best to defer funding till March or June 2023. And there's a simple reason why I say that. I think there's a lot of there's a lot of uncertainty, not just locally but also globally. And once winter is done in Europe, once we have some visibility and clarity on what's happening to oil markets, once we have some sense and clarity on what's happening to the US rate environment, which I think a lot of people feel and think and believe should be there by the time we get to March or June 2023, we'll also get a lot of clarity in the local environment. There could be good news. It's possible that the 8% reading we got on the US inflation rate may be the peak and that market turns down. And if the rate outlook for future rate hikes in the US changes, that changes the rate outlook for Pakistan also. If oil prices come down dramatically, drastically, energy prices come down, natural gas as well as oil, that changes our CAD outlook dramatically. The rate outlook changes, the energy outlook changes, the CAD outlook changes, and the global economy sort of tries to sort of pick itself up from where it is right now. We will also hopefully benefit given the fact that we're the 40th, 50th largest exporter globally. So March or June 2023 for some resolution to the uncertainty and the premium associated with that uncertainty in our current environment. If you can't wait till March or June 23, then just raise a smaller round. I think it's very counterintuitive. Everybody's saying raise money now, lock in your runway for the next 2 years, walk away from the uncertainty. But again, it's a question of what do you want to do as a founder? Do you want to retain and not dilute your stake? Or do you want to take a risk and see if survival is possible with a shorter round? The other side of the coin is, you can keep 95% of something which is worth zero because you've died, or you can keep 5 such and something which is very, very valuable because you've managed to survive. There are two sides of this equation. One is survival, the other is dilution. Which one is more important? If dilution is more important, you want to risk survival, raise a smaller round. If survival is more important, raise a larger round. Only you can be the right judge of what matters more to you at this specific point in time, dilution and survival. There's a third option, and that third option is if you have that path, if you have that in front of you, if you can go and hit cash flow positive, then that's best. Then you can defer the funding conversation indefinitely till you get to a point where markets are more rational, more sensible. But as my economist friends say on a regular basis, markets can afford to stay irrational longer than you can remain solvent or liquid. My third and final point is reevaluate all internal choices. Doesn't matter whether you're raising or not raising, reevaluate all internal choices using significantly higher market-based IRR. If you're adding a product, building a feature, hiring a resource, buying a computer, laptop, printer, or generator, run that math at 35% IRR dollar denominated. And if that math makes sense, go ahead and do it. If it doesn't, step back, defer, delay, or kill that specific project. So that's all we had on the rate outlook. Thank you very much for your time, patience, and attention. This is Jawwad Farid signing off for financetrainingcourse.com.